Good evening. It's Friday, January 9th, 2026. And if you're watching this, you need to understand something critical that happened over the past 96 hours. Something that connects Trump's military seizure of Venezuela, the quiet collapse of the US dollar, your home's value, and a stock market sitting at the second most expensive valuation in 155 years. This isn't about one story. This is about the moment when 5 separate dominoes, each positioned years apart, finally touched. And when the first one falls, which happened last weekend, the cascade becomes unstoppable. Let me show you what I mean. On Saturday, January 3rd, at 2 a.m., the United States conducted a military operation involving over 150 aircraft to capture Venezuelan President Nicolas Maduro. By noon, Trump was at Mar-a-Lago announcing that the U.S. would run Venezuela and extract 30 to 50 million barrels of oil worth $2.8 billion. That's the headline everyone saw. Here's what they missed. That announcement set off a chain reaction that is currently moving through the Treasury market, the Federal Reserve, the housing sector, and straight into your investment portfolio. The implications are staggering, and they're happening right now, because here's the connection nobody's talking about. Venezuela holds 303 billion barrels of oil, a fifth of the world's proven reserves. To rebuild that infrastructure from decades of decay will cost 58 billion minimum, possibly over 100 billion, according to Rice University's Latin America Energy Program. That's a decade-long project requiring massive amounts of copper, steel, and silver. Yes, silver. Every electrical contact, every high-performance wire, every refinery upgrade needs it. But here's where it gets interesting. On January 1st, just 72 hours before the Venezuela operation, China implemented export restrictions on silver. They now control 70% of the global refined silver supply, and only 44 companies have government licenses to export. The timing, let's call it strategic. Silver hit $80 per ounce this week, up 165% from a year ago. Gold surged to $45, up 66% in 2025, its best year since 1979. Bank of America is projecting silver could reach $135 to $309. These are not speculative assets responding to hype. These are strategic materials responding to geopolitical chess moves. Meanwhile, the S&P 500 is trading at a Shiller PE ratio of 40, the most expensive valuation since the dot-com bubble burst in 2000. Warren Buffett's favorite indicator, market cap to GDP, sits at 225%. Anything above 160% is considered significantly overvalued. The last time it approached 200% was right before the 2000 crash. The Federal Reserve Chair, Jerome Powell, warned in September that stocks were fairly highly valued. Fed officials noted stretched asset valuations and highlighted the possibility of a disorderly fall in equity prices. That was before silver spiked 30% in a month. In the US dollar, the DXY index just fell to 98, down 10% from its 2025 highs. Morgan Stanley projects it dropping to 94 by Q2 2026, the lowest level since 2021. That's the sharpest annual drop in 8 years. So let me connect these dots for you. Military action in Venezuela triggers a decade-long infrastructure build-out requiring strategic metals. China controls the metals and restricts exports days before the operation. Metal prices explode, the dollar weakens, stock valuations hit historic extremes. Housing affordability reaches the worst level since data collection began. And we are entering a midterm election year where historically the S&P 500 averages just 1% returns, not the 16% we saw in 2025. This isn't 5 separate stories. This is one story, and it's the story of capital flowing away from paper assets and into hard assets, away from Western financial engineering and toward Eastern resource dominance, away from the assumptions that held for 40 years and into a new regime that most investors are not prepared for. Let's start with the foundation of everything, the US dollar. Because if you don't understand what's happening to the dollar, you can't understand what's coming for stocks, bonds, real estate, or your retirement account. The dollar index closed 2025 down nearly 10% from its highs, but that number doesn't capture the full picture. Against the euro, the dollar depreciated 13.5%. Against the Swiss franc, 13.9%. Even against emerging market currencies, it fell 5.6%. Now, many analysts are calling this normal cyclical weakness as the Federal Reserve cuts rates. And on the surface, that makes sense. Lower interest rates mean lower yields. Lower yields mean less demand for dollar-denominated assets. Capital flows to other currencies, offering better returns. But here's what changes the equation. This isn't just cyclical. The structural supports are cracking. Look at global reserve holdings. The IMF reports that as of Q3 2025, the dollar represented 56.92% of global FX reserves. That sounds dominant, right? It is. But compare that to where it was a decade ago. The trend line is down consistently year after year. Central banks are diversifying. Not rapidly, not dramatically, but persistently. China and Russia have been leading the shift, building the BRICS payment system and settling trades in yuan and rubles. Now we're seeing Saudi Arabia price oil sales to China in yuan. The UAE is exploring similar arrangements. These aren't headline-grabbing events, but they're structural shifts that reduce dollar demand at the margin. And margins matter when you're talking about trillions in global trade. Every percentage point of reserve diversification away from dollars reduces demand for treasury bonds. Lower demand means higher yields required to attract buyers. Higher yields mean higher government borrowing costs. At $35 trillion in debt and rising, that math becomes devastating quickly. The Congressional Budget Office projects the U.S. will add $1 trillion in debt approximately every 100 days through 2026. That pace is accelerating. Soon, it will be every 60 days, every 30 days. The interest payments alone now exceed defense spending. We're not servicing debt with productive economic output anymore. We're servicing it by issuing more debt. This is the death spiral that has consumed every fiat currency in history. Not suddenly, not in a crash, but in a slow, grinding loss of purchasing power that investors only recognize in hindsight when they realize their retirement savings are half of what they used to be. But here's where 2026 becomes dangerous. The dollar is weakening at precisely the moment when asset valuations are extreme. Geopolitical tensions are rising, and the Federal Reserve's independence is being questioned. Trump has made it clear he wants more control over Fed policy. In May 2026, Jerome Powell's term ends. Trump gets to appoint a new Fed chair. The speculation in financial markets is that Trump will choose someone more amenable to keeping rates low to support the economy and the stock market heading into the 2026 midterms. If that happens, if the Fed's credibility as an independent inflation fighter erodes, the dollar doesn't just drift lower. It gaps lower because the one thing supporting the dollar, despite massive debt and deficits, has been the belief that the Federal Reserve will defend price stability. Remove that belief, and the exodus accelerates. Now, combine that with Trump's tariff policies. The average tax on U.S. imports rose to 16.8% in 2025, the highest level since 1935. 4 New York Federal Reserve economists published a report in December examining Trump's 2018-2019 China tariffs. They found that companies directly affected saw declines in employment, labor productivity, sales, and profits from 2019 to 2021. Tariffs are inflationary. They increase costs for businesses and consumers, but they also reduce economic growth by disrupting supply chains and trade. So we get the worst of both worlds: higher inflation and lower growth, stagflation. In a stagflationary environment, the dollar typically weakens because there's no growth to attract capital, but plenty of inflation to reduce purchasing power. Morgan Stanley's forecast shows the dollar falling to 94 on the DXY by Q2 2026, then recovering to 100 by year end as the economy rebounds and fiscal stimulus kicks in. That V-shaped projection assumes everything goes according to plan. But what if it doesn't? What if the AI investment boom that's been propping up tech stocks and the broader economy stumbles? What if the $3 trillion in data center and AI infrastructure spending that's been acting as a backstop for job creation and economic growth fails to produce expected returns? 26% of institutional investors cite an AI bubble as the biggest risk for 2026. If that bubble pops, if companies like Microsoft, Google, and Nvidia fail to show AI spending producing actual profit growth, you get a double whammy. Tech stocks crash, dragging the S&P 500 down, and foreign investors flee U.S. equities. Dollar demand collapses. In that scenario, the dollar doesn't stop at 94. It breaks through support levels that have held for years. When currencies break key technical levels, the moves accelerate because stop losses trigger automated selling. Now, let's talk about the asset that most people care about most: stocks. Specifically, the S&P 500. The S&P gained 16% in 2025. That marks 3 consecutive years of double-digit returns. On the surface, that looks healthy. But when you examine the underlying structure, you realize we're walking on ice that's far thinner than it appears. The Shiller P/E ratio, which averages inflation-adjusted earnings over the past decade to smooth out business cycle volatility, currently sits at roughly 40. The long-term historical average is 17.3. We've only been above 40 a few times in 155 years of data. The most notable occasion was October 2000, right before the dot-com crash. Here's what happened after every previous instance when the S&P 500's monthly Shiller P/E exceeded 39. Over the next 12 months, the index delivered negative returns more often than positive. Over 3-year periods, returns were substantially below historical averages. Over 10-year periods, returns improved, but only after enduring painful drawdowns first. Before we go further, I need to be completely transparent with you about why this analysis matters and why you should consider subscribing to this channel. Most financial media wants to keep you calm. They want you believing that markets always go up, that crashes are unpredictable black swan events, and that the best strategy is to close your eyes and hold. That's terrible advice built on incomplete data. The truth is that market crashes follow patterns. They follow extremes in valuation, extremes in sentiment, and extremes in leverage. And right now, all three are flashing red. But you won't hear that on CNBC. You won't read it in Bloomberg because their business model depends on you staying invested, staying optimistic, and generating fees. This channel exists for a different reason. We're not trying to sell you a mutual fund. We're not trying to upsell you to premium services. We're trying to give you the analytical framework to understand what's actually happening beneath the headlines, the connections between geopolitics, monetary policy, and asset prices that determine whether your portfolio survives or gets destroyed. If this feels helpful so far, let's continue. Subscribe and turn on notifications to keep future videos from passing you by. Many are responses to your comments. All right, let's continue. First, timing matters more in 2026 than it has in a decade. We're in a transition year where the rules that worked for the past 3 years stop working. The channels that gave you bullish calls from 2023 to 2025 made you money, but those same channels will cost you money in 2026 if they don't adapt. We update this analysis daily, tracking the exact indicators that signal when risk changes. Second, most investors don't realize they're holding the same portfolio strategy that failed in 2000 and 2008. Tech-heavy growth tilted, assuming that this time is different. The only thing that is different this time is the names of the companies and the technology they're working on. The valuation dynamics are identical, and when valuations revert, the losses are catastrophic. We break down portfolio construction strategies that actually work in transitional markets. Third, this channel connects dots. Most analysis gives you isolated stories. Here's what happened in Venezuela. Here's what the Fed said. Here's where gold went. But those stories are connected through currency flows, commodity dependencies, and leverage structures. Understanding those connections is the difference between reacting to events and anticipating them. I spent 15 years in institutional finance, watching billions of dollars move through markets based on information asymmetries. The big money knows things before they hit mainstream news. They position ahead of moves. Then they let retail investors chase headlines. Subscribing to this channel puts you closer to that institutional information flow. Not because we have insider information, we don't, but because we analyze the same data sources that institutions use before the interpretations get filtered through mainstream media. So if you're serious about protecting your portfolio in 2026, hit subscribe, hit the bell icon, and understand that the time to prepare for volatility is before it happens, not after. Now, let's continue with what's happening in the stock market because this gets worse. The Buffett indicator, total U.S. stock market capitalization divided by GDP, currently sits at 225%. Anything above 160% is considered significantly overvalued. The last time we approached 200% was early 2000, right before the tech wreck. The market fell 50% over the next 2.5 years. But beyond valuation, there's a timing factor that should terrify anyone holding stocks through 2026. It's a midterm election year. Since 1957, the S&P 500 has averaged just 1% returns, excluding dividends, in midterm election years. That's compared to a 9% average annual return since 1957. The peak-to-trough drawdown in midterm years has averaged 17.5% since 1950, the largest average correction of any year in the presidential cycle. Why? Uncertainty. When a third of Senate seats and every House seat is up for grabs, investors do know whether the party in power will maintain control or whether the president's agenda will get blocked. That uncertainty keeps buyers on the sidelines, and markets need buyers to go up. Republicans currently hold a narrow House majority. A shift of just a few seats gives Democrats control and effectively ends Trump's ability to pass major legislation. That possibility alone creates a risk premium in equity prices. But it gets more complicated. Trump himself said at the House Republican retreat on January 6th, "You got to win the midterms. Because if we don't win the midterms, I'll get impeached." That statement reveals how he's thinking about the stakes. And Elon Musk, who took a break from politics after the Epstein Files controversy, just recommitted to funding Republicans in 2026, posting on X, "America is toast if the radical left wins." So we have a president telling his party that failure means his impeachment, the world's richest man funding the election, and a stock market priced for perfection. Assuming policies remain supportive if Republicans lose, the policy uncertainty spike would be immediate. Tax cuts could be rolled back. Tariffs might be negotiated down. The regulatory environment for tech could shift. All of that creates downward pressure on earnings estimates, and earnings estimates are already stretched. The S&P 500's forward PE ratio is 22, well above the historical average. To justify that multiple, companies need to deliver growth, but growth is slowing. ISM Manufacturing PMI showed the sharpest contraction in factory activity since 2024. Services PMI was revised lower. These are leading indicators suggesting the economy is losing momentum. Now, layer in the AI wildcard, NVIDIA trades at a 25x forward PE, which seems reasonable, but that multiple assumes AI infrastructure spending continues to accelerate indefinitely. What happens if it plateaus? What happens if businesses start asking for a return on investment from their AI projects and find the results underwhelming? $3 trillion, that's the projected spending on AI infrastructure through 2026. If even a portion of that spending disappoints, if companies pull back on CapEx, you get a cyclical downturn in semiconductors. And semiconductor downturns are vicious. We saw 80-90% drawdowns in chip stocks during the 2000 bust. Even during the 2008 crisis, NVIDIA fell 80% from peak to trough. The assumption baked into current valuations is that AI is a secular decade-long growth trend that justifies premium multiples. But what if it's cyclical? What if we're 3 years into a 5-year semiconductor cycle and the peak is behind us? Then these stocks aren't undervalued at 25x forward earnings. They're massively overvalued. History suggests we find out the answer in 2026 because that is when the economics of AI need to start showing up in productivity gains, revenue growth, and margin expansion. If they don't, the narrative shifts from AI revolution to AI overhype. The narrative shifts in growth stocks create 40-50% corrections in months, not years. Now, let's address the asset that Americans consider their primary wealth vehicle, their home. Housing prices rose 25% from 1920 to 2024. Median home values hit record highs. Inventory remained constrained. Mortgage rates stayed above 6%. The conventional wisdom was that prices would stay elevated because supply was tight and sellers with 3% mortgages were not moving. But something shifted in late 2025, and it's accelerating now. Redfin calls 2026 the Great Housing Reset. Not a crash, a reset. Income growth is finally starting to outpace home price growth for the first time since the Great Recession. That sounds positive. It means homes are becoming incrementally more affordable. But it also means that the appreciation trade is over. For investors who bought real estate as an inflation hedge or a wealth storage vehicle, stagnant or declining home values change the entire risk-reward calculation. You're holding an illiquid asset that costs money in taxes, maintenance, and insurance while generating zero return. That's a negative carry trade. And nobody wants to hold negative carry assets in a rising rate environment, or worse, a recession. 22 of the largest 100 U.S. cities are projected to see year-over-year home price declines in 2026, according to Realtor. Calm? Most are in the southeast and west. Florida and Texas are leading the downside because they saw massive population inflows during the pandemic, leading to building booms that created oversupply in certain markets. But here's the concerning part. One housing analyst, a former Treasury official, predicts a correction worse than 2008 that could begin in earnest in 2026. She projects prices could fall until median home values align with median household incomes. That would be a 50% decline from current levels in many markets. Now, I don't think we see a 2008 style crash. The structural conditions are different. Homeowners today have equity. They have good credit. Mortgage delinquency rates are low. There's no subprime crisis waiting to explode. The foreclosure pipeline isn't building. But even without a crash, a reset is painful. If you bought a home in 2023 at the peak with a 7% mortgage and you are now watching your home's value decline, you're locked in. You can't sell without taking a loss. You can't refinance because rates didn't fall enough. You're stuck paying a high-cost mortgage on a depreciating asset. For the economy, this matters because household wealth drives consumer spending. The top 10% of earners account for roughly 40% of consumer spending in the U.S. Those households own multiple properties, hold significant stock portfolios, and base their spending on their net worth. If home values decline 10 to 15% and stock portfolios correct 20 to 25%, their wealth effect reverses. They pull back on discretionary spending. Economic growth slows, corporate earnings disappoint, and stocks correct further. It's a feedback loop, and the catalyst is always the same. Asset prices get so high that they stop attracting new buyers. When buyer demand weakens even slightly, prices need to adjust to find equilibrium. But in illiquid markets like real estate, price discovery doesn't happen smoothly. It happens in steps. Small declines at first, then accelerating as motivated sellers try to get out before prices fall further. We're in the first phase now, the small declines phase. Time on market is rising. Days on market hit 64 days nationally in November 2025, the 20th consecutive month of year-over-year increases. That tells you buyers aren't in a rush. They're waiting for better prices, for lower rates, for more certainty. And when buyers wait, sellers eventually break, especially sellers who over-leveraged thinking appreciation would continue forever. This brings us full circle to where we started. Precious metals. Gold closed at $2,925 per ounce, up 66%. Silver surged 165% year over year to hit $80 this week. These aren't just strong performances, these are historic moves. Gold's 2025 gain was its best since 1979. Silver's gain was the best since we have reliable data. Now, most investors view gold and silver as inflation hedges or safe havens, and there's truth to that. When people lose confidence in paper currency, they buy gold. When geopolitical risk rises, they buy gold. Gold is the anti-dollar trade. But what's happening right now is different. This isn't just safe haven buying, it's structural demand. Central banks bought 36,000 tons of gold globally in recent years, according to the World Gold Council. That's not investment buying, that's reserve building. Countries are preparing their balance sheets for a world where the dollar is less dominant. China has been the largest buyer. Russia increased its holdings despite sanctions. Even countries like Poland and Turkey are accumulating. And then there's silver. Silver is different from gold because it's not just a monetary metal, it's an industrial metal. Half of silver demand comes from industrial use: electronics, solar panels, EVs, medical devices. And that demand is not elastic. You can't just stop producing solar panels because silver gets expensive. You need silver to manufacture them. So when supply gets tight, prices spike. China's January 1st export restrictions created a supply shock. 70% of refined silver supply is now controlled by one country that just demonstrated it is willing to weaponize that control. Meanwhile, industrial demand is accelerating. The solar industry alone consumed 20 to 30 grams of silver per panel in 2025. With global solar installation capacity expanding rapidly, that creates 60 out of 80 million ounces of additional demand per year. The Silver Institute projects 2025 will be the fifth consecutive year of structural deficit. Demand exceeded supply. Those deficits are cumulative. They deplete above-ground inventories. And COMEX registered silver inventories have fallen 70% since 2020. That's not a statistic. That's a crisis. Bank of America analysts published a note projecting silver could reach $135 to $130 per ounce in their bull case scenarios. Now, those are tail risk numbers, but the fact that a major bank is even discussing triple-digit silver tells you how tight the supply-demand balance has become. And here's the tell. The signal that separates what's happening now from normal commodity cycles. Silver is outperforming gold by a massive margin. The gold to silver ratio fell from 90.1 in early 2025 to roughly 54.1 today. That's a dramatic compression. Historically, when silver outperforms gold, it signals that investors expect industrial demand to surge while monetary conditions remain loose. Translation: the market is pricing in inflation, supply constraints, and continued fiscal stimulus all at once. That's the setup for a commodity supercycle, and we're in the early innings. So let me tie all of this together, because when you step back and look at the full picture, a pattern emerges. We have the most expensive stock market valuation in a generation, a housing market entering a multi-year reset as affordability improves through price normalization, a US dollar weakening on concerns about fiscal sustainability and Fed independence, precious metals soaring as central banks diversify reserves, and industrial demand tightening supply. Geopolitical tensions are rising as major powers compete for control of strategic resources, a midterm election creating policy uncertainty in a narrow majority Congress, and an AI investment boom that needs to start showing returns or risk becoming the next tech bubble. These aren't separate events. They're all manifestations of the same underlying shift. Capital is leaving the 40-year regime built on financialization, leverage, and dollar dominance. It's moving toward a new regime built on hard assets, resource control, and multipolar currency systems. This transition doesn't happen in a day. It doesn't happen in a crash. It happens in fits and starts. You get periods where stocks rally on hope, then they correct on reality. Real estate flatlines. Precious metals consolidate. The dollar bounces on safe haven flows. But the direction is clear, and the timing matters because transitions create winners and losers. In bull markets, you buy dips. In bear markets, dips are opportunities to reduce exposure. We're not in a clear bear market yet, but we are transitioning out of a bull market. And when regimes change, the playbook changes with them. That's why staying informed matters more now than at any point in the cycle. This channel will track every data point that truly matters through 2026. Federal Reserve decisions, midterm polling, dollar technicals, commodity supply chains. Because the story doesn't stand still, it evolves daily, and your positioning needs to evolve with it. Here's what I believe is coming over the next 6 months. The US dollar declines toward 94, in line with Morgan Stanley's outlook, and potentially lower if concerns around Federal Reserve independence accelerate. That shift puts pressure on foreign capital flows into U.S. equities. The S&P 500 tests the 48,800 to 5,000 range, a 15 to 20% pullback from current levels sometime between February and June. This aligns with a historical midterm weakness window. The catalyst could be disappointing earnings, slowdown in AI-related spending, or an unexpected policy shock tied to the midterms. Housing prices ease 5 to 10% nationally, with select markets down 15 to 20%. This is not a collapse, it's a normalization, but for those holding the asset, it won't feel comfortable. Silver moves through $100 per ounce. Gold advances toward $5,000, not in a straight line. There will be corrections along the way, but the broader trend remains higher as supply constraints persist and monetary debasement continues. Then, if this timing proves right, the second half brings stabilization. Midterm uncertainty fades. Infrastructure spending and tariff policies begin to show real economic impact. The dollar steadies, equities form a bottom and begin rebuilding, but the bottom is likely lower than where we are today. And the path between here and there will be volatile. The opportunity isn't in trying to capture every short-term move. It's in positioning thoughtfully before volatility takes hold. Because once it does, emotions tend to replace discipline. Fear and greed creep in, and that's when small mistakes turn into lasting ones. So, position with intention. Stay patient. Trust the process. Protecting capital during down markets is what gives you flexibility and confidence when the next upcycle begins. This is the market narrative. If this perspective adds clarity beyond what you're hearing elsewhere, consider subscribing and sharing it. We'll navigate this transition together.